specialist.
Welcome back. Might be a quiet opening today, but during the course of the day we might get significant news flow from the Reserve Bank of India and maybe even from New Delhi. So might have a volatile session even if the start is slightly on the quieter side. And Jayakumar of Prime Securities joins in to talk about the market now. Jake's morning. How are you feeling about the second half of the year now? Is visibility still clouded, or you think the market can work with 4800 as a base?
I'd go with the thesis that 4800, give or take, 50, 100 points may well be the base that the market will work around. I think it's been climbing the proverbial wall of worry right through for the last now almost a year and a half, notwithstanding these sharp bear market rallies, as people have been terming them. So I think the market will find its feet slowly, and there are multiple things that are sort of some succor or relief to the market in that sense, and not the least of them being that the government is finally beginning to want to speak, if not speaking already, want to speak. So I think we could have a much better second half, much more constructive from a mid-cap perspective.
Jake's morning. So 4800 base with significant upside, you think, and what would you characterize it as? Another sharp bear market rally, or would it be of a different nature, you think, the kind of recovery we see in the second half?
Well, I'm not categorizing it as a bear market rally. I just think that the market gets into these extreme sort of pessimism modes, zones, if you will, and then bounces back. So the sharpness of the move indicates to me that the market is sort of making these, from a chart perspective, higher bottoms, if you will. If I remember right, 4530 or thereabouts was the bottom that we made a while ago. Then we made about 4720, and this time we made a higher bottom. And I think what we're doing is really, absorbing news as we go along. Wouldn't surprise me if closer to December or first quarter next year, we move towards the 5800, 6000 range also. Because I think the reality is that across the board there's just so much news flow that the market is absorbing that it's impossible to believe that either one or the other will actually make for any great will be the one deciding move for the markets. From an India perspective, I think the two things that are completely outside the government's control and which actually hold key for the rest of the year. One is oil prices and the second is the monsoon. And I think once you've determined that these two are well outside the government's control, then we'll stop looking at Delhi for any direction other than hoping that there's no major goof up in terms of things like GAR and so on and so forth. So as long as some basic clarity on what we need in terms of policy formation comes through, I think we're really looking at the oil price and monsoon, and the monsoons really, to determine where the markets go. And that's why I believe that 5,800 to 6,000, given my orientation on these two factors, that's why I believe that those levels could be reached.
The recent price action has been resilient and encouraging, Jakes. The only thing one worries about is as we get into the period that you're talking about, towards the end of the year, do you expect or fear that there might be more concern about global growth? Some people are talking about a global recession or recession-like conditions. How much of a headwind could growth actually present to the upward journey that you're talking about?
I think we've been waiting to have the sort of, the whole world going crazy on India several years ago, saying this is the next best thing after white bread. It was to invest in India. I mean, that was the kind of mood, and we created a top for several years to come in that sense when we hit 6,300 early 2008. So I think today it's exactly the opposite. Rating agencies, policy makers, economists, and so on and so forth are going completely crazy, bemoaning the lack of direction from Delhi. And in that context, if you have global headwinds as well, one of the things that's very clear is that oil had no business to be in the 125 range all these years. or in the 100 to 125 range. And therefore, I believe we may be well into a period for the next 12-18 months where the WTI may range between 65 to 80. And if you go back to interviews that we've been having, we've been actually extremely bearish on crude, and we think even the war premium would disappear as far as the Brent is concerned, and we think a steady state Brent in the 80-85 range, WTI maybe 70-75 range, could be the order of the day for the second half, in keeping with global fundamentals. And in that context, if India were to chart out from a 5%, which everybody now believes is the kind of lowball number that we will hit, if we were to build a base, you will find that India, therefore, with all the negatives now known to everybody, offers the kind of 5% growth clarity which is not there in many parts of the world. So I think that looking at it differently, a 5% with the tailwinds of oil prices, the monsoons are even reasonable. I think we could make a pretty constructive bottom around 4,800, 5,000 and move 20% higher from that towards the end of the year. And I think global fears, if anything, will only indicate even further that we need to look back, which is probably the reason already that you are actually having virtually no selling from foreign investors, other than this ETF flow that comes in and goes out. And to my mind, the ETF flows are very similar to the hedge fund flows of the 2005, 6, 7 era. And if that is the case, that's the only quote-unquote hot money or sort of volatile money that comes in. But long-term investors, whether sovereign funds, PE funds, etc., are pretty constructive on India. In a very perverse sense, you could say that the dollar-rupee move and the markets have kind of made it impossible for people to want to sell out if you have a long-term basis. Fair enough. But on the other hand, it also makes entry point for new funds that much better. You're talking about a 56, 57 plus dollar-rupee entry point and an effective dollar index, if you will, for all practical purposes on the mid-cap side, well below 3,000. But even otherwise, the dollar index, the Nifty just adjusted for the dollar-rupee move, is already in the 3,500, 3,700 range. So from an entry point perspective, I don't think you can ask for better. My own sense is that, if I were to put my neck on the line, I think buying into the Indian markets is almost a no-brainer at this point in time.
How would you play this then, Jakes? Would you buy the big banks, the big infra, or take a mid-cap call? I mean, how do you play the second half of the year?
I think if you were to be in the frontliners and you were to let's say look at the interest rate sensitives in the banks, for instance, then we'd focus on names like Yes Bank, for instance, banks that are significantly removed from the NPA issues of other bigger banks. We would take slightly more constructive micro calls on the space itself through names like Yes Bank or IndusInd Bank. These would be our favorites in that space. Other than that, every space we'd need to go down to because I think it's a stock specific market in what may well turn out to be a broadly uptrending market. So clearly in an uptrend, the frontliners will need to do well, otherwise the index won't move up. But we think that we'd go for specific names like the ones that we talked about. Our preference would, however, still be on the mid-cap space, where we'd focus very heavily on the auto ancillary space, the textile space, being extremely sensitive to the weak rupee, because we think that, and even engineering goods to some extent, because we think that the RBI premise of boosting exports, which may not happen in necessarily the short run, but give it a quarter and the impact of this will settle in. And already we're talking to names in the auto ancillary space and in the textile space which are talking about significantly higher export numbers for this year, even as early as June of 2012 for the FY 12-13 period. So I think the export story is definitely a story that we think is here. And while I might be a little brash by saying that is the next best thing after IT in 1992 when the dollar rupee weakened, I think it may well turn out to be, given what's happening in China, the labor situation there, etc., etc. I think any should I say labor intensive export oriented industries may well turn out to be the spaces that could attract money, and these, if you notice, are extremely under-owned, are not places where people have made money in recent times, and therefore, especially with the decimation of the auto ancillary industry, for instance, in Europe, I think it's natural that people will look for more stable sources, more stable suppliers, and the Indian markets are offering them exactly that. So in the initial phase there may be this thing about some dollar rupee adjustment, etc., but net all these exporters will tell you that there's enough margin on the table, and with the incentives being thrown for exports, here's a little story that I wanted to mention, that several years ago the RBI went hell for leather against, I repeat, against the real estate space, and what's happened to the real estate space over a 3-year period since. Then they came down heavily on the microfinance space, and that's got almost decimated since. Then it happened to the gold finance companies. Perversely, the RBI has now decided to go extremely gung-ho in terms of boosting exports. And if that's one thing that the RBI has said extremely clearly over a period of time, it is that, especially over the last 2-3 policy announcements, is that they want to boost exports, whether it's refinance, whether it's interest subvention, whether it's export, ECBs, whether it is export refinancing, whatever. In that context, I think if we had just gone along with what the RBI wanted, in terms of getting out of the spaces that they were against over a period of time, curiously enough, they might well have given us the lead into one space that will really benefit over this period, which is therefore the export space. So that, and I have been a great fan of RBI except for their currency management policy, but if you dovetail that with their sort of almost devilish obsession for exports, I think you will realize that a weak rupee is well and truly within the framework of the policy that they're set out. The management of the rupee, however, and the volatility thereof leaves much to be desired, but that's a separate story for a separate day.
Along with any positive macro announcements though, Jakes, would you be worried about this micro sectoral level interference, something like cement, for instance, that happened last week? Do you think that could continue to happen?
I feel what's happening is that we haven't realized it, but whether there have been these small microcosm of movements, whether it's the Anna Hazare or others, they may have been irritating sidelights on a front page, but frankly I think they have resulted in substantially higher fear levels amongst public functionaries in terms of carrying out their duties. And I think nobody is above law is a truism in most parts of the world not followed. In India it may well turn out to be a reality that it's an animal that we've sort of let loose without actually desiring to do it in that manner, but the reality is that that might well have proved to be a very interesting sidelight of the Indian market, that governance and fear levels in terms of public functioning may well have gone to a new level. Of course, there is the other side of it, which is that functionaries are extremely scared taking decisions, and I think there we need to, when the government needs to do something which promotes decision making rather than paralyzes these into inaction. But having said that, I think it's very good that cement companies, having consolidated beyond belief over the last 10 years, are now finding that these nice well cushioned relationships, otherwise called cartels, cannot exist. And I think it's a great wake-up call even for that industry. So while consolidation is a big theme and therefore promotes profit making, etc., but profiteering through cartelization, I think is going to come down. They're going to come down heavily on it. I think if RTI, to my mind, was really the next best thing after independence that we got, where any common man can ask any questions about most things in public domain, I think things like the CCI may well turn out to be the icing on that cake.
Right now we're only discussing the baby steps of whether the market has put a base in place for itself, whether it's got a more durable rally coming, Jakes. But are you feeling more confident about next year and the fact that there could be much more significant gains for the market to be made? I mean, new highs are very far, but a significant upside going into the next year?
Since we're discussing macros, I think it's important to point out that markets peak out when the issuance of equity, other than euphoria, etc., that people know and talk about, when euphoria is the highest, when people want to invest, apart from those reasons, when issuance of equity is at its kind of peak, if you will, which was the case in 2008, where literally all kinds of issuances of equity were happening. Perversely or conversely, the markets actually make a base when equity is actually being sucked out of the markets. To which I'd like to point out the one comment that we've been having across channels is that the biggest buyers of equity in the market today on a sustainable basis are actually promoters of companies. And that's something that we need to look at in the context that whether it's through buybacks, whether it's through delisting like the Alpha Lavals of the world, the Atlas Copcos, or any number of other delistings which threaten to happen, or it is the ABBs and the Siemens where there's a creeping up in terms of 5 or 7% being added to the promoter holding, or the whole bunch of delistings in the Indian context, the Indian promoters. Really speaking, there's a net depletion of the existing equity stock from the markets. And when that, in a sense, dovetails with the pessimism, the headwinds, etc., that to my mind marks almost a climactic bottom at this point in time. That the markets really today are seeing on a daily basis promoters who are the most sustainable buyers of their equity, because most Indian promoters at any time in the last 30 years that I've been, 25, 27 years that I've been working, would have told you that we have a listing because at any point in time we can issue equity and raise money for what is required in terms of business of the company. Now if that equation has changed and nobody is willing to contribute in terms of equity dilutions, QIPs, etc., IPOs are virtually dead, then you're talking about a market where rather than this equation holding true that we have a listing because we can raise money, and promoters are now saying that this listing price makes no sense, we're not going to get money, might as well increase our holding in times like this or delist. I think you're talking about a very, very strong signal which retail investors would do well not to ignore. And while retail investors have been the smartest in this market, I've been out of the markets for almost now 3.5, 4 years, I think it's probably a great time to convert some of the savings into investments, especially, as I said, in spaces like the ones we talked about, and with managements where creeping acquisitions or increasing of holding is well and truly happening.
Okay, time for a break. When we come back, let's switch to the trading side of the market again, talk about stocks which might move today. Back in a minute.